The IMF sees the world's biggest economy still growing at a robust pace, with estimates for US GDP growth of 2.5% this year and 2.7% in 2025. While the global lender has noted a decline in global inflation, it remains cautious about the issue.
There are stark divergences also between countries that call for careful calibration of monetary policy. The strong recent performance of the United States reflects robust productivity growth and growth in labor supply, but also strong demand pressures that could add to inflation. This calls for a cautious and gradual approach to easing by the Federal Reserve.
Conversely, it sees growth in the euro area of 0.8% in 2024, but says this is coming from a very low base, hinting that the European Central Bank would do well to start easing rates sooner rather than later.
By contrast, growth in the euro area will rebound this year, but from very low levels. Unlike in the United States, there is little evidence of a hot economy, and the European Central Bank will need to carefully calibrate the pivot towards monetary easing.
Meanwhile, fears around interest rates remaining higher for much longer more broadly, as well as bubbling tensions in the Middle East, have seen market jitters, with global stock markets, including the local JSE, selling off as a result in recent sessions. The IMF says it's still too early to predict how things may progress or otherwise in the Middle East, but that it has looked at a number of possible, in some cases, extreme scenarios.
We looked at a scenario where we would have more geopolitical tensions that would result in elevated oil prices and energy prices and shipping costs. And what we find is that this would lead to higher price pressures in the global economy. There would be higher inflation, there would be lower output, and roughly the estimates we have for a sustained increase in oil prices by about 15% would be an increase in inflation globally of about 0.7%.
While it's difficult to control external headwinds, the IMF continues to encourage nations to ensure their fiscal balances are in check, although there are concerns that in an election year for many countries, public purse strings may be loosened to appeal to voters.
A key priority is to rebuild fiscal buffers, especially in an environment with high real interest rates, modest growth, and elevated debts. Unfortunately, planned fiscal adjustments are often insufficient and could be derailed further given the record number of elections this year.
The IMF called on nations to do more to invest in the green transition, adding that the cutting down of greenhouse gas emissions was compatible with growth, and urged technology transfer from advanced economies to emerging ones with the partnering of private and public financing to bring clean projects to fruition. Nompumelo Siziba, SABC News, Johannesburg.